Hi guys, welcome to another video. So this is the part 2 for the investment banking questions, and in this video we are going to discuss about the investment banking questions, and apart from that the valuation questions as well. That is a crucial for your business understanding and business making, etc. So what are the some examples for the industry specific multiples are there? So first one is technology, like EV by unique visitors or EV by page views, etc. Then we have the retail or airlines. Let's say EV by Bitar. It's earning before interest, tax depreciation, amortization, rentals. So one thing is that energy. It's a EV by Bitax, earning before interest, tax depreciation, amortization, explanation expense. EV by daily production. EV by crude reserve quantity. So that one is there. Then we have the real estate investment trust. It's a price by FFO per share or price by AFO per share. So we can say that the fund from the operations or adjusted fund from the operations are there. So this is something like that. Then we have the technology and energy. So if you are looking at traffic and energy reserves as a value driver rather than revenue or profit, so this is something like that. Or for the retails and airlines, you added back the rent because some companies often own their own buildings and capitalize the expense. So that is something like that. Others and rent, etc. Rental expenses are there. Then we have the energy. Like for the energies, all values derived from the company reserve oil and gases. So there's a company reserve of oils and gases. So this one is there, which explain the last two multiples. EBITDAX that exits because of some company capitalized their exploration expense and some expense them. So this is one, and you add back the exploration expense to normalize the numbers. So this is another number for them. So this is something for RIT, like you can say that the fund from the operations is a very common metric, and that adds back the depreciation and subtract the gains from the sales of property. Or depreciation is non-cash, you have the extremely large balance in the real expenses or the cash, so you have to get it done by the different methods of parameters. That is relatively good for them, but you have the gains on the sale of projects or the properties that assume to be non-recurring. And FFO is gives a normalized picture of the cash flow for the REIT that is generating on the different parameters. So this is something like that. When you are looking at the industry specific multiples like EV by scientific or EV by subscribers, why do you use the enterprise value rather than the equity value? So you use the enterprise value because those scientists and subscribers are available to all the investors, both debt and equity in the company. And the same logic doesn't apply to the everything, because you need to think through the multiples and see which investors are particular metrics are available to. So this is something like that. And if you go to the LBO or the DCF, that's give a higher valuation. So technically it could go either way, like, but in the most cases LBO give a lower valuation. And here's the easiest way to think about that, like with LBO, or you can say that you do not get any valuation from the cash flow of company between the year one and final year, so you are always valuing it on the based on terminal value. So with the DCF, by the contrast, you are taking into the account both the company's cash flow or between its terminal value. So that's value tend to be higher for them. And unlike the DCF or LBO, like that doesn't give the specific valuation. Instead, you set the desired IRR. So it's determined the how much you have to pay for the company on the basis of that. Now, after the valuation methodology, like how to present these valuation methodology to the company to the investors. Usually we use the football field chart that show the valuation range implied by the each methodology. You always show the range rather than the one specific number, because as an example, like the C10 pages of the documents, and this evaluation done by the Credit Suisse for the leverage buyout. So this is something like that. And how would you value Apple tree? The same way you would use or you value a company by looking at what the comparable Apple trees are, and the value of the apple's worth, or you can treat cash flow as based on the different intrinsic value of the things. And you could use a DCF for anything, even an apple tree, so that will be a different number for the different parameters of the guys, but we can think through that, like this is the one thing we are working on. And when you can't EBITDA multiple rather than this, like EBITDA is available to all the investors in the company rather than the just the equity shareholders, because the enterprise value is also available to the all the shareholder. That will make the sense for them to pair them together. Equity value by EBITDA is comparing the apple to oranges, because the equity does not reflect the company's entire capital structure. only the part available to the equity investors that is defined here. So this is something like that. Let's meet in the next video for the better part and for the investment banking setbacks. So please follow the channel and like the videos for the more content.